UAV drone and camera technology is a growing market for personal use and businesses. By taking advantage of the piqued interest in these technologies, especially by millennials and small businesses, our target markets, Company F developed superior UAV drone and camera products at the best value globally. Our vision is to offer a superior product at the best value globally. Think of us like the president's choice of the drone and camera industry. We offer great prices, but we do not sacrifice value. We can also look at OnePlus and compare our value for money strategy. Our financial goal was not to go in debt and to reinvest our profits back into our facilities, marketing initiatives, repurchasing stocks, and paying out dividends to our investors. We are a cautious company financially, taking measured risks, but through that strategy, we were able to remain in the top 3 companies for majority of the decade. Now, a bit about our products. Our camera product enhancements for editing and sharing capabilities are top of the line, as our target market is keen on being able to turn around footage for work and for sharing on social media quickly. We developed our UAV drone features to be key in areas where the drone's performance would be enhanced. For example, the camera stabilizer and 6 rotators will create a steady image and smooth movement without having a large impact on the price. With 3 camera models and 2 UAV drone models currently in our production line, we will continue to develop and enhance the current models for the next year, before rolling out new enhanced models in year 13. Company F believes in a positive work environment for our employees with fair wages, benefits, and incentives. We invested in a cafeteria and on-site child facilities for our employees, and we also applied institutions of a supplier code of conduct and compliance monitoring of suppliers in our facilities. In addition to this, we provided the best practices and productivity improvement training, plus offered fringe benefit packages to our employees, as health and safety are our number one concern. Investing in additional safety equipment and improved lighting and ventilation was done in our first year of operation. Not only did these investments increase the safety of our workplace, but it also improved the productivity.
Our earnings per share have been the least successful of our financial performance indicators, remaining consistently and significantly lower than investors' expectations. Starting off year 6 at 86 cents, we declared more dividends, repurchased stocks, and bought more workstations, which brought up our EPS by $1.42 and landed us in the top 3 in both the EPS and overall scoreboard at $2.28. At the end of the simulation in year 11, we stood at $7.07, and although our EPS was consistently lower than our investors' expectations, our results were higher than the overall average across all companies. Unlike our EPS results, our return on equity numbers remain significantly higher than our investors' expectations. Our company began the simulation right under the IE of $16 at $13.90. After issuing the dividends and repurchasing stocks in year 7's decisions, our main focus became bringing up investors' equity. We experienced a steady increase in profits during the first few years, with a jump in year 8 to year 9 from $75,655 to $129,265. Our ROE peak score, which we experienced only slight increases thereafter. Throughout the majority of the simulation, we have managed to remain in the top 3 under ROE, with our final year score just missing 3rd rank. The company's stock price results, just like the ROE, have remained well above the investors' expectations and wavered in the top 3 highest positions among the class companies throughout the simulation. Our company wanted to provide value to its shareholders, so we had aimed to keep our financial position high while focusing on both short-term and long-term goals. Deal with any potential financially hindering threats such as debts and overspending, or jumping at opportunities such as using our excess cash for dividends and stock repurchasing. Playing it safe throughout the majority of the simulation had definitely hindered the results of our company in comparison to others, but with steady and more confident adjustments to our dividends and stock repurchases, we were able to land in 3rd place in stock price at $204.97.
As a company, we have put forth a lot of effort to ensure that our credit rating met or exceeded investor expectations. A good credit rating attracts investors because it shows that we have a strong capacity to pay back debts and that we can withstand economic changes. Aside from year 1, where our credit rating was a B+, our credit score has either been an A or A-, with A- for year 11. These scores are also competitive in our industry. One reason for a consistent credit score is that other than the relatively small loan taken for the robotics upgrade, we have not needed debt financing. We were able to make changes and upgrades to the business by the use of yearly revenues and saved up cash. There are also a few ratios that are considered when creating a rating. Firstly, it is the debt to equity ratio. For our company, the ratio is projected to be 26 to 74 by year 12. This is a relatively low number because we have little debt and therefore have less risk to be affected by interest changes. Next, our interest coverage ratio is very high due to the lack of loans. It shows that we have more than enough capital to pay back the interest on our loans. Lastly, our current ratio is projected to be around 1.8 for year 12. Having a current ratio of 1.8 means that we have more assets than liabilities and is one of the highest when compared to our competitors.
Both our AC and UAV products have been consistently designed to perform above industry expectations. Our products are intended to be slightly below the industry's highest performing products. The mid-range products are developed to provide optimal hardware where it matters. By reducing costs in other areas, we were able to increase expenditures to focus on camera upgrades. The products have been established to provide day-to-day consumers with economically affordable pricing and sufficient features for individuals looking to engage with online communities or to pursue personal projects. Our competitive advantage stems from our more than affordable pricing and mid-range positioning. By providing consumers that are seeking well-performing core features versus buzz features, we were able to overcome competition in the mid-range category. Our product pricing has consistently been on the lower end of the scale throughout all years. In year 11, our AC cameras generated the second highest demand in the North American market of 428,000 units and market share of 18.1%, while being market leaders in the Asia-Pacific markets with 19.8% of market share. We were able to maintain a second or third place position in all other markets. Our UAV drones trailed in a third position of its North American segments, capturing 16.2% of the market. Our marketing plan originally started by primarily utilizing website display ads with moderate budget on general advertising. However, over the years, we've slowly transitioned from website display ads to more dependencies on advertising and retailer support. The intention behind this was to first generate brand salience and gain a strong web presence. Once satisfied with our developed brand awareness, we decided to focus on promoting through our sales channels to grow brand equity. By providing additional support to retailers and advertising, we could push consumers that were already interested in purchasing a product in the markets we serve to purchase one of our products. The North American market was the main focus of our advertising budget. We found that North Americans responded more favorably to advertising, whereas other markets did not engage as enthusiastically to advertising efforts. Instead, we focused our marketing budget towards retailer support in all other markets.
Throughout the simulation, one of our main goals as a company was to be consistent and offer products that are high in quality but low in cost. However, our company still put more resources into selling our products in North America and Europe, Asia. This is because these two regions is where most of our money is made. For both products, we spend the most on marketing for those regions. To add on, North America also has the lowest delivery cost. For UAV drones, North America pays around $50 per unit, compared to the other regions where they pay around $115 to $145 per unit. For AC cameras, North America pays $5 per unit, while the other regions pay $15 to $20 per unit.